Sean, Thursday, March 8, 2018. Part of the genesis of this blog is to provide a historical record of trade ideas, and just as important, the justification behind them. And looking back now, it appears I like to talk about CAD, which is strange since I really never traded it all that often. The loonie has gotten kicked around the past month or so, ending in this brilliant Twitter post: "Every currency should be represented by some kind of animal so we can have more of this." Then the super quants chimed in. Jens Nordvig's ex-ante data posted this today. That got the wheels turning. First, is CAD really underperforming? And if so, is it underperforming because of amorphous residual factors that one could call collective NAFTA risk rather than more discernible ones? Let's go to the facts. First, if we look at a pack of commodity currencies over the past year, CAD falls nicely in the middle of the range. On a shorter time scale, the underperformance is more apparent. Since the beginning of the year, CAD can't get out of its own way, but it really started to trade ugly around the end of January. This is where the NAFTA risk story breaks down. No chance MXN is at the top of this performance table if the risk of a NAFTA blow-up were increasing. Indeed, as I highlighted last week, if anything, MXN is arguably pricing in significant political risks as well, leading me to assume there is little if any NAFTA risk priced into either MXN or CAD. So where does that leave CAD? I can't compete with the sentient machine learning models at ex-ante data, but I can come up with a crude regression model of my own, which is like comparing a Bugatti to a go-kart built with scavenged lawnmower parts. Borrowing from some inputs and ideas in the JP Morgan model, I modeled up CAD against oil, 1Y1Y CAD USD rate spreads, and S. The takeaway I get from this is that the blow-up in volume and the pullback in equity risk has taken significant air out of the tires for CAD. The model value for CAD rose from 1.24 to 1.32 in a short period of time, and spot was slow to catch up. When it got moving, traders didn't waste any time in gunning it towards 1.30. But was it just the equity sell-off at work? Turns out the data played a part too. This chart is the Barclays Economic Data Surprise Indexes for the US and Canada. The Canadian index craters throughout February, while the US index chops around a more narrow range. When combined with higher equity and currency volume and lower stock prices, it's a clear trigger for traders that had done well holding long CAD positions throughout 2017 to hit the exits. Similarly, in the rates space, there was some change in pricing the BOC hiking cycle, but nothing earth-shattering. On January 25, this is what was priced in. AYE 2018 rate of 1.84%. Today that rate is 1.74%. Does 10 bits per second in the front end equate to a 4 to 5% underperformance in the currency relative to other commodity currencies? That's a bit much to me, but it points to the overall trend that the weakness in the currency is being driven by a reversal in short-term economic indicators rather than the residual NAFTA risk, political risk, or the risk Justin Trudeau is in fact the spawn of Fidel Castro. Did the Trump tariff news play a role here? Doesn't look like it to me. The bulk of the underperformance was prior to that, but yeah, never know. It would be reasonable to use that as the explanatory variable to support underperformance relative to MXN, but the data isn't there to support that. Currency trading is about much more than interest rate spreads and current account deficits. At its most basic level, it is about the relative rate of return in different economies, and in this case when the short volume, equity momentum finally broke down, at least in its previous iteration, it signaled break in potential growth rates in Canada, and combined with some additional macro-prudential measures to soften the real estate market, it took a good deal of the shine out of CAD. Bottom line, when you look at a mean reversion in what had been a very strong run of economic data, the underperformance relative to MXN, and a regression analysis that makes the recent weakness in CAD look more in line with the fundamentals, there isn't as much to panic about. What's next for CAD? It seems like the market is onto something here, and there is good evidence that the business cycle is looking rather tired, despite a strong print from the IVPMI earlier this week. That said, my guts say the market seems to have gotten a bit offside here, pushing CAD too much relative to the underlying drivers. Despite the naysayers, I think the weak USD trade is intact, so I'm inclined to catch the NAFTA here and sell USD CAD, but just can't get too excited about it so long as it continues to screen marginally rich on my regression model and the model inputs continue to point towards a weaker currency. SeanTMacroman2@gmail.com